Hello everyone, this is Natalia Ito and I'm a CPA with Colorado Business CPA. In this video, I want to go over a short-term rentals, the accounting and tax questions and issues you might have. We are a CPA firm, full service CPA firm, and we specialize in preparing tax returns as well as doing the tax planning for investors, who invest in real estate, as well as short-term investors such as Airbnb, as well as business owners. So let's get started. So let's get started to the overview. So what taxes do you pay when you have a Airbnb? How to receive a tax-free treatment for some of your Airbnbs or a second home, for example. We'll go over the operating expenses, tax deductions, loss limitations, and how to avoid them. When you sell your real estate property, what you need to look for, record-keeping tax filings, and also how to minimize audit risk. So when you put a property for Airbnb, obviously you want to make sure you are in compliance with your state and local taxes, tax and licenses departments, right? So you want to make sure you have a sales tax license, which could also be called a lodging taxes. It could also be like a license, and you want to make sure you have a short-term rental license, which is paid annually. Your tax, you would have to pay the lodging, rental taxes and sales taxes. Like, for example, Denver, it's 14.75%. And again, some of those taxes are called room tax, bed tax, gross receipt tax, tourist tax. You just want to make sure, like, you do apply for your sales tax, lodging tax with your jurisdictions where your property is located, and you want to make sure you're in compliance. Again, check with your local cities, collect directly. The taxes are collected directly. And, if you're renting your property via Airbnb and VRBO, perhaps they already taking taxes and submitting on your behalf. So you just want to make sure you are filing a tax return, sales tax, which is lodging tax returns on time. So let's talk about when you're renting your property, your Airbnb, is that considered is your income considered a subject to self-employment income tax, or is it treated like a rental and it's a strict goes to the income taxes? So if you are involved, not only like you're involved in renting this property, but you're the one who is managing this property, meaning you're the one who is cleaning the property, you're the one who is perhaps providing entertainment, maybe even like breakfast for your guests, then it will look like you are have a business, Airbnb business, kind of like B&B in a business, and therefore you would report those activities on Schedule C, and that would be the net income from those activities will be subject to self-employment tax. And if you're, for example, if you have a property, let's say in the mountains, you like live in Denver, but you have a property in the Winter Park or Breckenridge, and you have a cleaning crew there, you have somebody who's managing the maintenance people, then most likely this is not your business, this is your rental property, and therefore you will report those rental activities on Schedule E. Also, like when you live in Denver, you have to basically you can Airbnb your property, but it has to be your primary residence. And then so sometimes people buy rental primary residence and then convert portion of their homes as a Airbnb. And in this case, again, it depends, like, is this your main business, is this your profession, or do you also have a W-2 or a business, a different business, and somebody's taking care of this property? So then again, if somebody is taking care of this property, they're cleaning, they do maintenance work, then those rental activities will be reported on Schedule E. So the next thing is the tax-free treatment, and it's you can rent your second home, or if you just purchased Airbnb property, for example, in the mountains, and you're renting this property less than 14 days, you can utilize Augusta rule, which means it allows you to exempt up to 14 days of rental income. But again, you can only rent this property for no more than 14 days. Like, for example, if you have Airbnb, it's fully functioning. Let's say you're renting it for 60 days to, I don't know, to customers, and then you're like, oh, I want to rent for 14 days to somebody else, like to myself or to my business. Well, that rule is not going to work, meaning you have to have the rental property cannot be rented for more than 14 days total. So that would work really well, like if you're not renting your second home, but perhaps you are renting the second home to your business. If you have a business and you perform some board of director meetings there, some company retreats, maybe employee company parties, then you can rent your second home, even your primary residence, to your business up to 14 days, and you will pay no tax, recognize an income, and then your business or your business actually can take a deduction. So it's not only like you can rent your Airbnb property for 14 days to somebody else and you won't have to show that as an income. And obviously, you're not going to be able to deduct expenses against this income. But also, like if you have a business, your business can rent this property from you. Your business will write a check and will deduct those expenses on the business return, but you personally will not recognize that income. And this is, again, utilizing Augusta rule. So the rental property price must be reasonable. Again, primary residence can be used. And again, expenses are not deducted. So this is a 14, you can rent it for up to 14 days by utilizing Augusta rule. So now let's talk about the rental income. So what is considered a rental income? Rental income is basically your rental income and the property and services you receive in lieu of rent. For example, if you have a tenant and your tenant is handy and he or she is fixing your property and say, oh, okay, you know what, I'm not going to pay you $300 in addition to, for as my rent today this month because I have been doing the work on your house, on your property, but you still need to show that as a rental income. And of course, you will deduct the $300 as an expense, as like a maintenance, repairs and maintenance expense. So rental expenses that are paid by guests, also would be taxable to you. Reservation cancellation fees, some other fees, like for example, pets deposits, which are non-refundable, for example, like a pet fees, all those are rental income. And security deposits is not income unless it's used to pay for damages. So for example, you have a property, you paid $2,000 in a security deposit, they damaged the floor now costs $1,500 or so to repair. Well, that $1,000 you received is going to be recognized as an income, and then the $1,500 or so you would have to spend repairing the flooring, that's also going to be an expense to you. Okay, so operating expenses and rental properties are the ones that are ordinary and necessary. So repairs and maintenance. And the property improvements are depreciated over 27 and a half years. So you will say, okay, well, what's the difference? Well, if you are fixing, and let's say you're installing a new kitchen, or you're putting a brand new floor, or you're putting new walls, well, those are like a property improvements. And therefore, those items will be depreciated over 27 and a half years. But for example, if you're changing a light bulb, well, then it's obviously repair and maintenance, right? Depreciation is a must. You must depreciate your property. So let's say you purchased a condo for $275,000. You would have to allocate, 10 or 15, 20% of that property cost, for land. And again, the best way to, for you to allocate that, you can look at the county, like a property assessments, and see like how the government allocates between the building and the land. And then so you allocate, let's say 10, 15, 20% of that cost of the property you have purchased, because you're not just probably, let's say you bought a property for 275, but you also have to, you probably paid some closing fees. So, and then you take the total expenses, the total cost, and then you allocate, let's say, 20% of that to land, and the land is not depreciated, and then the other 80% would be depreciated over 27 and a half years. You can also utilize a segregation. So what that means is, there are some companies that will segregate some costs. Let's say, like if you bought an Airbnb with furniture, for example, that furniture will be, you can deduct the furniture expenses as an expense. You depreciate, fully depreciate the cost of the furniture if you purchased a furnished Airbnb in the same year when you actually place the property for rent. So again, this is a depreciation segregation. So basically you can allocate some of the items in the property you purchased, and some of that could be depreciated right away, which means it speeds up the depreciation, and you can offset those costs against your other income. Again, just like we talk about the furniture and appliances. Operating expenses. What would be the operating expenses? Well, that would be a rental platform costs, local, state, and licenses and fees, advertising and marketing, car and transportation. I would not put the entire car on the balance sheet when you have one or two rental properties. I mean, if you have a 20 properties, yes, probably, because most likely you're the one who is managing those properties. But a car and transportation, I would say, deduct the mileage. If, let's say, if your property is located, nearby, and if your property is located in a different state, then you would deduct the travel expenses, right? You can allocate some of the expenses to the home office, like if you need some area to manage your property, preparing invoices, marketing, ordering some supplies and stuff like that. Legal and professional services, supplies, cleaning, repairs, and maintenance, and also could be a startup cost. Startup cost is something that's a cost occurred before you purchase the property. For example, you wanted to, rent a property in Florida. So you went to Florida, you kind of checked on several properties, but then you had a travel expenses, meals expenses, and then those expenses would be considered as startup expenses because they occurred before you purchased a rental property. So you can deduct those expenses as well. Also, if you are utilizing like your primary residence and you are renting this primary residence also for Airbnb, then some of those expenses would be allocated between a rental, Schedule E, for example, and your Schedule A, where you would, deduct the interest and taxes, property taxes. So operating expenses that you would be allocating between a personal use and a business or investment property use is a rent or mortgage interest, property mortgage, insurance, real estate taxes, utility bills, credit card interest, parking, rental insurance. Rental insurance most likely won't allocate because that's the reason why you have purchased the rental insurance, is to cover the rental activities. HOAs and special assessments, yes, those will be allocated. And then the refinanced mortgage, if you have refinanced your mortgage and you have your old mortgage fees still, to be amortized over the life of the loan, but now you got a new loan, deduct your old mortgage fees because, because they're not applicable anymore. There's no need to amortize them over the life of the loan because you got a new loan. So this could also create a good expense. So loss limitation, as long as you materially participate, you can deduct losses from your rental up to $25,000 against your ordinary income. And, if you just purchase the property and you purchase this with interest, with a loan, most likely you will have a loss because not only you need some time to set up this Airbnb, you invest in their furniture, let's say furniture, supplies, cleaning, maybe even some like light maintenance and repairs, but also you would be depreciating the property. And again, so most likely you will generate a loss. So if your ordinary income, let's say your W-2 income is less than $125,000, or even like $100,000, you can deduct up to $25,000 in those losses and offset those rental losses against your ordinary income. But if you're making, let's say, $300,000, those losses, unless you are a real estate professional, those losses will be carried forward because you won't be able to deduct those losses against your ordinary income. Because let's say you're an engineer and you have a couple of rental properties. Yes, you actively participate in the rentals, but you're not a real estate professional. You work maybe as a doctor or dentist. So what that means is those losses will be carried forward. It's not like you're gonna lose them. You're not gonna lose those losses, but like, and then they will be carried forward until four things could happen, right? One is your income will go down below $100,000, and then you can take those losses, or you sell the property and you'll be able to offset those losses against your gains, or your will start generating income. You start generating income, and of course, those the income generated from the property will be offsetting those losses. Or you become a real estate professional, like you will be involved more than 750 hours per year. You'll get your license, and you're like, you know what, I'm done being engineer, dentist, or a doctor. I want to be a real estate professional, and then you will be able to deduct those losses without limitation. So here's a real estate professional rule. So there's no limitation on the losses, all deducted in the current year. You might generate even like a loss for the entire on the entire tax return. No problem. It's not, those losses are not limited, but you must spend at least 51% of your time working on rental properties. You must spend at least 750 hours, which is like 751 hours per year working on your properties in real estate business. And then getting a real estate license can be very, very handy. And then again, you want to make sure you have a material participation. When you sell your rental properties, if you're selling a personal resident, you might have to take that depreciation recapture, because if you have rented your property, your primary residence portion of that house was rented. Now you have to, because remember, you have to depreciate this property. So now you have to take that depreciation recapture and then show income on that. You can, perform perhaps, you can utilize a 1031 exchange depending on the amount of the gain. It might make sense for you to utilize 1031 exchange. But with the 1031 exchange, you need to work with the qualified intermediaries who will they will guide you what the process looks like, but it's basically like kind exchange. Let's say you're selling your property. Let's say you had a property in Denver, and then now you want to buy a property in Florida and Airbnb this property. Well, this is a like kind exchange. It's a business property and a business rental property, business rental property, business rental property. It is within the United States. And then so what the 1031 exchange does, it defers capital gain. So let's say you bought a property for 200, you're selling it for 6, you have a 400,000 deferred gain. And then, so the new property is basically going to have your basis of about $200,000, because that $400,000 gain is going to be also deferred. It's going to be pushed to the new property, but it's deferred again. So that means the cost is going to be lower. And, and then like when you sell the second property, then, that's when you're going to recognize a $400,000 gain. But then again, you can also, perform another 1031 exchange and another 1031 exchange. And it can actually then later on, you can claim that as your main home and exclude the gain. But again, this is a process. And then you also need to talk to the qualified intermediaries to discuss this. But again, this is a very useful tool, very, popular in the real estate world. So just keep in mind about this 1031 exchange. And again, when you're selling the property, you want to pay attention to carryovers. Remember, we talked about the carryover losses. So you want to make sure like you're not losing any carryover losses, because those losses now will be helping you to offset the gains. Or perhaps if you have more losses, you might want to sell, perhaps if you like have losses in, in stocks, and you have a significant capital gain, you might want to sell some loss, some stocks or something to offset that capital gain. Right. Again, you want to make sure that the depreciation expense is taken. And then if you have your purchase property in Colorado before June 4th, 2009, you can actually be qualified for the Colorado capital gain exclusion on the purchase properties up to $100,000. So here's your $400,630 tax savings. Again, you just need to make sure you're reporting it, right? So record keeping and IRS audits, you want to talk to an attorney about how to, how to minimize the liability on your properties. You want to make sure you keep track of all the income and expenses, the mileage. You want to have a separate LLCs, get EINs, bank accounts, for your properties. And then, in order to minimize the audit risk, if you have those properties with your spouse or other investors, well, if you have those properties with other investors, you have no choice but file a Form 1065, which is a partnership tax return. Do not create S corporations or C corporations to have your real estate properties in. Just basically use LLC. If you're the only owner, then those LLC will be reported on a Schedule E of your individual tax return. And if you have partners, perhaps you might want to move, if you're like a spouse's partners, you might want to create a Form 1065 and file your rental properties on Form 1065. And the reason is because for audit protection, minimization risk. So IRS does audit Schedule E's more often than 1065. Again, if you have any questions, my name is Natalia A2. I'm a CPA, Colorado Business CPA. This is our contact information, and our phone number is 1-800-5040-272. Just give us a call, make an appointment, and we would love talking to you. And again, thank you so much for watching, and have a great day.